So to begin, today we're going to learn something. I'm going to teach you how to trade the ABC method. We'll also take a look at some of the orders that come about, scalping and Atlas line, ATO, whatever happens. I'll also show you. I'm going to start off here with this idea that the market, whatever market you're looking at, whether it's the E-mini, the Nasdaq, even currencies, if you're looking at the Forex market, has a specific section throughout the day or the session that it trades. And sometimes we see more action during the morning. Sometimes we see very slow action during the middle part of the session or the day. And sometimes the market slows down or could even increase towards the end of the day. So when we're looking at whatever market you happen to trade, it could even be coffee. It's a good market, coffee and soybeans. Whatever market you are looking at to trade, be sure that you understand that there are typically three sections or three parts throughout that market's day that it moves separately. Okay. Also, before I forget, I want to remind everybody that as a disclaimer, trading is risky. Please do your due diligence. Don't trade with funds you cannot afford to lose. Be very careful when you trade. Ask your broker about the risks of trading. I just want to get the disclaimer out of the way because I don't want anyone to trade unless you understand the risks. So we always tell everyone to practice, get a demo account. We can help you get a demo account as well to practice trading so you have an understanding of how to place orders, how this works, what is a market order, what is a stop order, what is an MIT order, market if touched, stop with a limit. There's also those type of orders. So these are things that we encourage everyone to learn and understand before just blatantly buying and selling, hoping that it's going to go in your favor. At least have a good concept of what's happening and how to place these orders and the risks involved. So let's take a look here at the E-mini S&P. We can look at any market, but it's typically the same. And I also have to say that some of you that are international can trade overnight. And the European market, they also call it the London market open. It's not always the London market open. There's the Asia market session as well. But these markets that you're looking at, they have a day session, they have an overnight session. So we're just going to focus on the day session for whatever market you're looking at. So let's say that you're in Europe or in England and you're looking at a currency. So you would look at a currency in your time zone. And so we would look at here, for example, 3 o'clock. 3 o'clock is the start of the day session in Europe for many of the markets. Eastern Standard Time I'm referring to, right? So this would be in England, 8 o'clock in the morning. I'm looking at the E-mini S&P. So this would be my day session here in the US, Eastern Standard Time, 9:30. So whatever market you're looking at, just remember it's in that time zone, that market, the day session. Okay, so 9:30 Eastern Standard in the US for E-mini. If you're looking at a euro, it would be 8 o'clock locally in England, 3 o'clock for me here, Eastern Standard Time. So before I continue, I just want to make sure everyone is clear on this idea of day session, London session, night session. Anyone have any questions so far? Sally, Mark, Greg, Joseph, Fritz, Cliff, everybody else? All right, so pretty straightforward, right? In the time zone you live in, right? In the markets you look at, just look at the day session. Very simple. Now, as the market starts the day, let's say, we have this push. Traders are buying, traders are selling. Sometimes there's news events as well. And so when I look at the first 2.5 hours of the day, typically it's actually the best time to trade. And so when I look at the first 2.5 hours of any market, Euro, US, London session, Asian session, US session, it's the best to trade. Now, there's a reason for this. Traders are waiting to jump in as soon as the market opens. There's typically news events as well. PPI, manufacturing index, maybe the Fed is releasing numbers, interest rates are changing. So you can definitely expect the market to make the big moves and the big push early on within the first 2.5 hours. And really, this is where you should be trading. If you look at my chart here, you can see that there's an indicator called the ATR, the average true range here. And this ATR is very important. I have many videos where I try to explain and teach traders how to use this. Not everybody uses it the same way I do, but I use it to tell me the current conditions. And it's a great predictor of what to expect. If this ATR is at a value of, let's say, 2 points, which is right here, 2 points. That means moving forward into the future, and I'll show you here what I mean. Moving forward into the future, I can expect the same 2 points, each of these candles moving up or down to have a range of 2 points. Now, it can change, and it does change. It's never going to stay constant at 2 points. As we see it here, it's actually increasing, but it will never deviate from this range of how large the candle is that dramatically from it being 2 points. And the same thing is true if I go here into the future candle by candle. It's 2.1, which is the equivalent of 2 points, 8 ticks. It's still 2 points. So into the future, you're not going to see this drastic change where a candle is, let's say, 8 ticks or 2 points or 8 pips, and then the very next candle it be 4 ticks or 4 pips or 1 point, or let's say 5 points, which is 20 ticks. It's not common that the market makes that much of a drastic change. And this is important to understand because if you're going to place a trade, you have a target in mind, you have a stop in mind. You have to say, well, what is my target and what is my stop? And why is my target and my stop that particular value? And it's based off of the way that I teach it. It's based off of what you see here as the ATR telling me I can expect 2 points of a move. That means my target should be about 2 points. It means that my stop can't be less than 2 points, or else I'm going to get knocked out of this trade just by the random movement up and down. And if I have a stop that's too large, it's unnecessary. I'm having a stop that's not relative to the current condition. So this idea of having the market relative to the current conditions and then placing a stop and a target because of that is really important. So you're always in check. You're not having too large of a stop. You're not having too small of a stop. You're not giving back or letting a large target get away from you because you always want a small target. You're having your target and your stop relative to the current conditions. So that's how I use the ATR in most of my trades, except for scalping. Scalping is typically 2, 3 ticks, 4 ticks, and you're in, you're out, and you're done. But for a 5-minute, 15-minute, 30 minutes, 60 minutes, all relative, you can trade it the same way with this ATR. And I like to use a setting of 4. I have it here as a setting of 14, but the setting that I like to use is a 4, by the way. Let's save that default. Okay, so the last 4 candles, I can expect 3 points. I can expect 2 3/4 of a point. I can expect 2 3/4 of a point. I can expect 2.5 points, 2.5 points, 2 1/4 of a point. So you see it changes by a tick or two up or down, but it doesn't change that dramatically. And I'm always looking at what's about to happen within the next 4 candles because I want to be in, I want to be out of this trade fairly quickly. All right, anyone have any questions? Using a setting of 4 on the average true range to tell me what to expect within the next 4 candles and then using that information for stops and targets. So the ABC method is based on looking at and dividing whatever market you're looking at into three sections. So the first section would be first 2.5 hours. Just write this down here, 2.5 hours. I'm going to use my local time here, which I know not everybody here is Eastern Standard Time, but from 9:30 to 12 o'clock, that would be the first 2.5 hours. And the first 2.5 hours, again, the most active, the most important to trade, a lot of opportunities. And you're going to see something else that is very common. The market typically, a good percentage of the time, 80%, 90%, begins to slow down here as we get into the middle part of the day or the noon or they call it the lunchtime. It's not really lunchtime, right? Because this is a world traded market. It's not lunch for everybody, but you can see the market slows down. And remember, I was showing you the ATR, how it's 2.25, 2.5, 2.75, back down to 2.25, 2.25, 2.25, and so forth, right? And as we get further along into the day, especially closing in to 2.5 hours, the market begins to slow down. So this is expected. I can show you many examples, and you can't expect here after 2.5 hours that the market is more volatile or that the market is trading much faster unless there's news or unless there's something in the world occurring that's causing that to occur. But that's not normal. What we can expect is the market to slow down as the day progresses. So the first 2.5 hours of the day, what happens? Market goes up, down, there's news, there's opportunities. You may be trading, you may be scalping. Some of you have the trade scalper, some of you have the ATO. All that is great. Now we come into the middle part of the day, which is what I call the B part of the day. So this is the B part of the day, and this is the A part of the day. And within the A part of the day, we can go ahead and place a range telling me this is what happened within the first 2.5 hours of any market. So whether this is the London Open, which would be from 3 a.m. my time to 5:30, that's 2.5 hours, or the Asia Open or the US Open that I'm looking at here, it's the same. It's 2.5 hours, the A part of the day. So what I'm looking at now is what to expect. How do I take advantage of this information? Well, believe it or not, markets don't really trend every day. They go up, they go down, they whipsaw. Everybody likes to look for a trend, but they're hard to find. And sometimes after they occur, you can realize, oh, that's a trend. We're trying to identify a trend for the day as early as possible. So if the market begins to break above or below the A part of the day, especially if it happens early on, if it happens within the first hour or hour and a half, that is a great predictor of a trending day. Now, I know that the market may have trended here earlier, but we're just waiting until this has been completed to think about a strong trending day. And every trending day that I've seen has the same characteristic, where as soon as the 2.5 hours have finished, the market either continues very early on, let's say 12:05, 12:10, 12:15, immediately just keeps on pushing higher, higher, or lower and lower, while in this B part of the day, this is an indication of a strong trending day. And those are the days everybody waits for, everybody wants to see. And so I want you to take advantage of it when it happens, because now you can buy or you can sell. And the rule to this, and I'll show you the software that's included with this, is I mean, a lot of traders, they modify these rules, but the way that I like to look at it is 2 consecutive candles closing above or below the A range. All right, so the first 2.5 hours is the A range. Let's see if I can make that a little bit larger. That's the A range. And after the first 2.5 hours, if I want to see the market show me a strong trending day, two candles closing above or below, but early on, that's the key, not towards the end of B. And so B here is also 2.5 hours. It's from 12 o'clock to 2:30. And this B part of the day, what you're seeing here is absolutely normal. It's nothing out of the ordinary that we can take advantage of as a trend. What you're seeing here is a containment within what happened during the first A session, or A section, I should say. Very typical of the market being contained within the A part of the day in any market, stocks, currencies, forex. It's only when you have two consecutive candles closing above or below this area that we take notice as a strong trending day, and then you can take advantage of that by buying and holding, or buying and selling and trailing a stop, as an example. But what you're seeing here is absolutely normal. It's nothing that we're seeing here is out of the market conditions. Now the C part of the day is the same thing. We're now going to take a look at what happens in the C part of the day. And the C part of the day is not looking at A, but it's looking at B. Just make that a little bit larger too. So the B part of the day here tells me the middle part of the day that it's quote unquote lunchtime, the market slows down. I understand the market slowing down because you see this started here and it just continued to get slower and slower and slower. So these are actual conditions that you can expect day after day, and you can use this to your advantage because you may not want to trade as the market gets slower, number one, and number two, you can make a decision whether the target and the stop should be tighter, smaller, larger, because we see that the market is slowing down. These candles are getting smaller. That's what the ATR is telling me. And it's happening during the middle part of the day, which is expected. So if you know, or as much information as you can understand and you can know to help you make the decision, should I buy or sell the market, is going to be on your side. Now, if you look at the C part of the day here, the C part of the day is a late day breakout, late day rally. Sally says here, what trading hours is this set to? Well, Sally, this is set to the um, Eastern Standard Time. So we're looking at the start of the session at 9:30 and ending, if we're looking at the E-mini S&P, ending at about 4:15, which is 1600. Here, 16:15. So the trading hours are Eastern Standard Time, starting at 9:30 to 12, 2.5 hours. This B part of the day is from 12. It's also 2.5 hours. From 12 to 2:30, which is 14:30 Army time. And then the C here is a little bit smaller. It's 1 hour and 45 minutes. I like to say an hour and a half, but we'll just say an hour and 45 minutes. And the C part of the day is the shorter part of the day. So this is 2.5 hours. This is 2.5 hours. This is a little bit smaller, an hour and 45. Again, it's the same idea. Will we have a late day rally or a late day sell-off? Will the market be strong as it breaks out? Maybe there's earnings, maybe the Fed, which always the earnings reports and the FOMC, it always occurs at about 2 to 2:30. That may trigger a buy or a sell as a late day breakout or a late day sell-off. And two consecutive candles, once again, closing above or below initiates an opportunity. So you see one candle here closing below, and you have one candle closing right back inside the range of B. So it's not, I repeat, it's not an opportunity to sell. The reason why I like to wait for two consecutive candles to clearly close beyond the range of B, or if you're trading here in B, two candles closing above or below the range of A, is because I need enough evidence to make that decision. I can't just see one candle because it could be a false breakout. Another thing that could happen is that besides it being a false breakout, it could be a bounce. All right, so I'm going to take this a step further. The market likes to test and bounce off of the high and low of A while trading in B. You'll see the market come right down to this price and bounce off of it, or right to this high and bounce off of it. And the same thing when trading in the C, the market will test the high and the low of B and bounce off of it. And I have to say the key thing here is the earlier it occurs in the B and the C, the better. So you see right over here that the market right after 5-10 minutes, these are 5-minute charts, the market hit the low of B and immediately reversed and bounced off of it and came back in. This is important because you can take this as a bounce to the long side. So you see the market hit the low of B, not continue with two consecutive candles for a late day sell-off, but instead reverse immediately, candle right after, and break out. So if you're looking at, and I don't really teach candlestick interpretation, but this would be considered, let's say, if you see an engulfing candle that looks like this. Again, whatever information you have to say to you, okay, it hit the low of B, it bounced off of it within the first 5-10 minutes of trading in C. It's a bullish engulfing candle, bearish engulfing candle, however you want to look at it. Uh, I'm buying it for that reason. And if you look at the ATR, you can see a target of 1.5, which is 6 ticks. My stop needs to be a little bit larger than that to keep me in the trade. Remember, every candle is about 6 ticks, 5-6 ticks in range. So if your stop is 3 ticks, just that random movement up and down is going to take you out. Sally, any questions for me? Mark, JR2, Joseph, Cliff, Fritz, everybody else? All right. Now, if I remove this here from my chart and I add the ABC indicator, we can fairly simply see this. I mean, you can do this manually, which I think is great for all you traders that don't have the software. But you can add here the ABC, and it does it for you automatically. And you can color code it, uh, and it provides you the signals as well. You don't need the software because I'm teaching this to you how it is. But you see it's the same idea. And you see here this ABC long right here. The text is the way the candle and the text works. It's centered, right? So you can offset this if you want the signal, but it's the center that you're seeing. And I can actually see if that works right now. Okay, so this here is buying at 29.94 quarter, which is the closing price of this candle. So we had a candle that closed outside the range of B. The very next candle closed back inside the range of B, and that's the reason for the buy, because it bounced off of it. Now you don't have to focus on the bounce, only you can focus on the breakouts, right? you can use this to your advantage if you have your own trading method and you say, I need a little extra confirmation to make sure that I'm doing this correct. And the market ends the session here. I would not take any of these trades if they occur late in these sections, right? It's not the same taking a trade that may break out here towards the end of the quadrant of the session. It's much more important to see the trades occur either breaking out or bouncing early on. The same thing is here. If there's a breakout happening nice and early in the B part of the day because it's breaking outside of A, perfect. It's a strong trending day. Take advantage of it. Trail a stop. Do all those things that you want to do. Or if it bounces, it should happen early. If it happens towards the end of this middle part of the day, so it's starting to break out, but it's happening here, forget it. It's not the same. Fritz says here, does this also apply in a 3-minute or other time frames? I like to use the 5-minute, Fritz. I would not go larger time frame. So I would not try a 10-minute or a 15-minute because it doesn't really give me enough time to see the candles. A 3-minute I think is fine. I wouldn't go 1 minute. My preference would be a 5-minute. I think a 3-minute is okay. There's nothing wrong with it with using a 3-minute chart. But I wouldn't go larger, and I wouldn't go much smaller than a 3-minute, Fritz. Okay, so let's take a look at a couple other examples, and I'll switch over to take a look at some orders for today on the Atlas line. So here is, this happens to be October 22nd, and actually I should show you more recent, yesterday and day before yesterday. I just happened to bring up this chart. It was October. So here we have a sell, and I always want to ask myself, whether you're trading any of my methods or not, why am I taking this trade? What is the reason? Whether the trade is a winning trade or a losing trade, it's always best to know I'm buying or selling for this reason. And the reason is because we have 2 consecutive candles closing outside of the range of B, right? So this is B here. And this is C. We have 2 consecutive candles closing outside the range of B. So this would be 1, this would be 2, 3,675, which is what the order is displaying, to go short. Now, obviously, this trade can turn around and reverse. It could be a complete failure. You could lose money. But there's a reason why we're entering short. It's because it's breaking outside the range of B early on. So remember, the key thing here is really to say it's happening earlier rather than later. And you see the market took off. If it happens to reverse on you and you're in this trade and it starts to close back inside this range, it means it's not ready. Maybe you should avoid taking another trade until it does the same thing, 2 consecutive candles closing. Maybe it's going to close above 2 consecutive close. You can take that. But if it starts to reverse on you, especially if it closes back inside this previous range, that's your ticket to get out. That's your exit. Of course, you want to have a stop as well, but that's really proof. I like to use proof to exit my trades. That'd be my proof to get out of the trade. In this example here, I mentioned to you that the market likes to test the highs and lows of A, right? So you can see it tested the high of A, did not go any further. The reason to buy it, 2 consecutive candles closing above, it didn't happen, or below, it didn't happen. Instead, it tested it and then reversed. And also, you see how I said to you the market starts to slow down after it opens. Again, it's a very typical and expected situation that you should know, and you can't expect the market to be more volatile. There will be days, it's based off of news. News will make the market be more volatile in the B and C parts of the day, but typically it doesn't. Not on a day-by-day basis. Okay, so for today, So this is yesterday. As you can see, typical day, nothing here to see. The market had the A, had the B, and had the C. And instead, the market tested the lows of A. It didn't give a signal to buy because the way that this is configured is that there has to be a closing price outside and a closing price immediately after back inside. So that's, to me, a true bounce. It's a false breakout coming out and then it immediately closing back in. So we didn't have that according to the rules to buy when this touched this here. But had it, that would have been a buy, but it's testing the lows of A. The same thing here. Here is the high of C. What did the market do? First 5 minutes, it tested it, but never broke above. And this is, again, typical. Use this information to your advantage when buying or selling at these areas because you know that if it's going to break out, the likelihood of it continuing is strong. Or if it's testing and bouncing off of the range of B, high or low, a high probability is that it's not going to continue higher. It's going to test it and go down. And you can see it's something like this. It goes up, it goes down, it goes up, it goes down. So I'm just using this information to my advantage. All right, questions? All right, everybody okay so far? All right, let's take a look at another day. And by the way, I believe we've updated this indicator, but I believe that this can be adjusted for the London Open as well. So since we're looking at the E-mini, I'll just set this to 3 o'clock, which is in my time, Eastern Standard, when the London Open begins. So I'll click that. And now I haven't looked at any of these values overnight, but it's the same rules. It's the same idea. Exactly the same thing occurs. This is the A, this is the B, and this is the C. And I'm going to just look at this last night. You see what happened there? The market had a wick that tested the highs of A. So if I remove the label, if it's not the E-mini, this could be the euro, it could be the Australian dollar. The British pound for futures is only $6.25, so I wouldn't recommend trading that. But it could be the Canadian dollar, it could be the Swiss franc. It could be any market. This just happens to be the E-mini. And the same thing, here is the low of A, and you see the market tested the low of A. It must have been some news event or something that occurred here overnight to have this large candle. And it came right back up. All right, so nothing here in C. Not really a test or anything happened here in C. So you can do this manually. The ABC software is included with the At the Open course, At the Open software. It's a bonus. And let's take a look at what happened the previous night. Same thing. Here is the high of A. Here is the test. Test again, but it couldn't break out. Now we have something a little different here. This is the C part of the day. You see you have a big and a very large candle break the range of B here. Now I think this was news driven because this is happening at 8:35 Eastern Standard, which is typically when news occurs. So I wouldn't recommend jumping in right as the news is occurring. 2 consecutive candles closing above the range of B, and that's the reason for the signal right here to go long. But obviously this did not continue higher. Market started to reverse. This is a huge candle as well. You have to be careful with these very large extended candles. Usually they're short-lived. But to go long, there's a reason. 2 consecutive candles, and that's why you see the signal. It didn't continue higher. Instead, it started to trail down. so you get out of the trade. We'll take a look at another one. Overnight, nothing. Slow. Overnight is typically slower too, but no closing above and no closing below. And in this example, a little bit different than the one we just saw. You see it gave 2 consecutive candles. It looks like news as well, so you have to be careful. In this example, it continued. In the previous example, it trailed off. So in this example, the 2 candles closing above let it continue. But I think the better trades really do happen earlier than the first 5, 10, 15 minutes of 4 or 5 candles of this breakout or of the reversal. And actually, this is a reversal right here, or a bounce right here. It hit the low and immediately reversed back up. Sounds good? Anyone have any questions? Hopefully that gave you a good perspective on the ABC. Let me switch gears here a little bit and take a look at adding Atlas line and see what's happening. I have not seen this, so I do not know what's happening with any of these other methods that I teach. So here is the Atlas line, and I'll add the ATO as well. The Atlas line can be configured. I'll remove the ABC. The Atlas line can be configured to start either the London session or the US session. It provides the signals, the same with the ATO. You can trade it during the overnight session on any market. If you have any questions on either of these, let me know. Okay, so this is the Atlas line for today. I know some of you here in the room have the Atlas line already, so you should have the same exact signals as I have here in my chart. We're going long 30, 70, 50. Remember, I like proof when I trade, so the Atlas line